Okay, folks, welcome. And I hope you had a good break. It was much of a break. And as I said in my yesterday's email, we're in the sprint part of the class now. We have 3 weeks left, I think, precisely starting. Yesterday was, I think, the 3 weeks, the clock started. We have 3 more things on your to-do list. The first, of course, is your quiz coming up a week from today, third quiz. The second is the project that's due on the last day of class, which is May 10th, and your final exam, which is May 17th, which is a week after your final class. So tomorrow I will send you kind of a to-do list on the project and things to wrap up, because I know some of you have been putting it off. And one of the things I would like you to start doing as you get the numbers, I know many of you are working on the optimal, is start entering those numbers into the Google shared spreadsheet. And I'll talk about why I need that before the last class starts. So I know you have a lot of time still, but I want to get you started on that. Are there any questions or before we start? Okay. So again, I'm having issues. I don't think it's a broadband issue. I've just diagnosed that my computer is on its last leg. Something is going on. So if I start lagging or my slides freeze, let me know. I'll turn off the video and see. We can make do. Right? So there are no questions. Let's go back to where we were. Before we left off before the break, we were talking about designing the perfect debt for your company. And I said, it's very simple. You tell me what you plan to invest in. I'll tell you what the right kind of debt for your company is. So if you take, for instance, and we're talking about, I think it was, who is it that was doing Boeing? Just now we were talking about it. No, you're doing Boeing. No.
Me. Believe.
Oh, Celine, you're doing Boeing. So when you take Boeing, and I said, what's the right kind of debt for you? Let's go item by item. What's a typical project for Boeing? It's really long term, right? 60, 70, 80 years, a really long-term debt. What currency are your cash flows in? Celine, you have an answer to that? What currency were their cash flows in last year?
Dollars?
Were they in dollars though? Because they sell a lot of planes to airlines in Asia. They used to denominate everything in US dollars, but I think they get their cash flows in renminbi and yen because they sell all over the world. And if you knew what the currency makeup of the cash flows was, your debt should be in the same currency. And I talked about inflation, and let me re-emphasize it because you might have forgotten what we talked about. If you have inflation, one of the questions I have is, do you have pricing power? And if you have pricing power, I said you're a much better candidate for floating rate debt. Why? Because then you can pass through those higher interest rates to your customers. And finally, if you're a growth company, I said you're a much better candidate for convertible debt. Why? Because you want to keep your interest payments low right now when your cash flows are low. And as you get more mature and your cash flows go up, you can let the debt convert and replace with straight debt. That's 90% of debt design, right? Duration of the debt, what currency should the debt be in, fixed or floating rate, straight or convertible. But there's one final aspect to debt design, which is where you can get creative. If you can somehow make the debt behave like your firm is behaving, where the cash flows go up and your firm is doing well and cash flows go down when the firm is doing badly, that would help, right? And I'll give you a couple of examples of debt design that try to capture this. In the early 1980s, a company called Sunshine Mining, it was a silver mining company, decided they want to issue debt. Now, if you're a silver or gold mining company issuing debt, you know what you worry about the most, right? Even though you might be doing really well right now, if silver or gold prices go up a lot, you can afford to pay a lot of interest payments. But if they drop a lot, you're going to be in trouble. So they wanted to design debt that captured this. And hence was born the first commodity bond. Sunshine Mining issued silver-linked bonds. What were silver-linked bonds? Basically, what they did was the coupon on the bond was tied to the price of silver. The price of silver went up, the coupon rate went up, the price of silver went down, the coupon rate went down. Commodity bonds essentially allow commodity companies to borrow money and not go bankrupt if the price of the commodity decreases. Here's another example. About 20 years ago, somebody from this class, they graduated, they went to work for Allstate in their finance group. So about a year or two into their job, they called me. They're very excited because the CFOs asked them to present on what the optimal capital structure for Allstate is. So they plugged the numbers in, came up with an optimal of 30%. Allstate's actual debt ratio was 6%. So we're very excited about what they found, that Allstate was massively underlevered. They made the presentation to the management team. And after the presentation, the person called me and very disappointed. They said, I went into the team and I told them that they were significantly underlevered, that they could afford to have 30%, and they're only 6%. And their response was, we know. And she asked, this person asked, why aren't you borrowing more then? And the answer was actually very simple. They said, we're always one catastrophe away, one disaster away from being in trouble. If you're a large insurance company, you know exactly what they're talking about, right? An earthquake in California, a hurricane in Florida, there goes your buffer. They said, we cannot borrow money, even though we know we can in a typical year, because all we need is one disaster and we're in trouble. So Jeremy, I'm going to put you on the spot. You're going to design debt for me. I'm an insurance company. I'm worried about this disaster that's going to wipe me out, but I still want to borrow money. I want to get the tax advantages of debt. Is there a way I could design a bond that allows me to borrow money and claim the tax benefits and not get into trouble if there's a disaster?
Well, I'm going to go ahead and say yes, there's a way.
And so tell me, what would you do? So as an insurance company, what would you like to build into the bond to give me protection? Could you build in a disaster clause that lets, remember, you can get lawyers to come in and write the bond any way you want, right? What if we could throw in a disaster clause in there that says, if there is a hurricane, you have to be specific, hurricane that causes more than $10 billion in damage in the Everglades, or an earthquake that causes more than that measures more than 8 on the Richter scale, we will suspend coupon payments for 5 years and maybe even reduce the principal payment.
Right.
You can do this. You say, why would I buy that bond? So why would somebody buy this bond? If you put that into a bond, why would somebody buy the bond? What do you give them in return? Clearly, the advantage is yours, right?
Yeah, you pay higher rates.
You're
going to agree to higher rates in exchange for that.
That's exactly right. In fact, what we've just described is called a catastrophe bond, or cat bonds. They're issued almost exclusively by small insurance companies that are worried about a disaster happening. And what it allows them to do is borrow money and not get into trouble in the event of a disaster. You could never get away with this on a bank loan. Banks would never agree to these terms, but with a corporate bond, you build it in, you pay a high enough rate. There's somebody out there who thinks they know more than you do and decide that they've got the farmer's almanac that tells them there's going to be no hurricane for the next 12 years. They go out and try to take advantage of that. The first step in debt design is to be creative. Creative, why? Because you want to create a bond that kind of captures your company, that does well when your company does well, does badly when your company does badly, when the cash flows are tied to the bond, because by doing that, you've reduced your default risk while preserving your tax advantages. So that's the first step, is you've designed a bond that behaves like equity, right? Because you built in flexibility, you get the tax advantage of debt and the flexibility of equity. That's your stop one. Now comes the second stop. You want to make sure that you haven't been too clever for your own good. Let me explain what I mean by that. Think of what you've just designed. You've designed a bond that looks like equity, right? And you might have done such a good job that the IRS looks at the security and says, you know what? This isn't debt. It's equity. And there goes all of your hard work, because the minute the IRS says that, you've lost the tax advantage. So you know what your second stop is? At the tax lawyer's office. And every large company probably has a tax lawyer on site. You go into his office and say, this is the security we've designed. Will it still pass the test to get us the tax deduction? For this, you really need to know the tax code. What will pass as debt? And that's where you might have to massage the bond to make it pass the test. You might want to maximize your tax benefits. So if you're a European company, even though you might have operations in Ireland, you might decide to put this bond in Germany because you get a bigger tax benefit in Germany than in Ireland. They're all euro debt anyway. You might restructure the bond because if you have zero coupon bonds, there might be special tax issues. Here's your last chance to make sure you get the maximum tax benefits from your debt. You design the perfect bond. You make sure you still get the tax benefits. And then comes a third step, and this is a really tricky one. Remember, as a publicly traded company, you have all these different interest groups to keep happy. So let me make you the CFO of a Midwestern company. And next week, you're going to make a big security offering. You're going to raise capital. So you fly out to New York, because that's where all the interest groups hang out. And your first stop of the day is at the Moody's offices, the ratings agencies. Now, what do ratings agencies focus on? They focus on default risk. They want your default risk to be low, right? So when you describe the security you're going to issue next week, are you going to describe it as debt or equity? What's the security offering that makes a ratings agency feel better about you? That you're going to borrow more money or raise more equity? Alex, what do you think the ratings agency would prefer that you use to raise capital? You're still muted, I'm sorry. There you go. I can't hear you, so maybe maybe it's my problem or no. Can you guys hear? No. Okay, now try.
Can you hear me now?
Now I can hear you now, yeah.
Okay, yeah. Ratings agencies would want you to issue equity.
Because if you issue debt, your default risk goes up. So they say so in the morning, 9:30 in the morning, you stop at Moody's, you convince Moody's you're going to be issuing equity next week. You say, what's the big deal? 3 hours later, you're in front of equity research analysts who track your company. Now, what do equity research analysts want you to do? Issue new shares or borrow money? Remember, equity research analysts have this fixation on per share numbers and dilution. The minute you issue shares, they freak out. No shares. That's terrible. So now comes the tricky part. You got to convince the equity research analysts that this security issuing next week, that you've already convinced the ratings agency's equity has now magically become debt. You're saying, how the heck can I pull that off? I'm going to give you a few examples of securities that thread this needle. So in the morning, the security was equity to the ratings agency. In the middle of the day, it's become debt to your equity research analysts. And if you're a regulated company, an insurance company, a bank, you got a third stop to make. You got to stop in front of the regulatory authorities who care about regulatory capital, which is almost always equity, and convince them that it's back to being equity. You're saying, how the heck am I going to create a security that's equity to the ratings agency, debt to the analyst, and back to being equity to the regulatory capital? Hey, no harm trying. You know how much money investment banks have made by creating securities that do different things with different interest groups? Let me give you an example. In the early 1990s, a Goldman Sachs banker invented a security called trust preferred stock. Now, preferred stock has been around in the US for 100 years. But preferred stock has always been expensive debt because the dividend on preferred stocks is usually not tax deductible. So when you issue preferred stock, you have to pay a dividend, you don't get the tax deduction you got in interest expenses. And you got to give this Goldman banker credit for being creative. He created a security called trust preferred stock, and I'm going to describe what trust preferred stock looks like, and I'm going to ask you which box you put it into, if you're thinking from a common sense perspective, debt or equity. First, it has a fixed dividend. It was set up front, so dollar amount. Second, that dividend was going to be tax deductible. And third, if you failed to pay that dividend, the trust preferred shareholders would acquire control, get voting rights in the company. Fixed dividend, tax deductible, and if you fail to pay it, you lose control of the company. Morgan, if you wanted to put this into a box, debt or equity, what does it look like? Fixed dividend, tax deductible, loss of control. Is it more debt or equity? What does it look like to you?
Equity.
Equity is usually not tax deductible, right? And equity usually, so because it's a fixed payment and it's tax deductible and loss of control, this looks a lot like debt, right? It meets all of the criteria for debt. But here's where the Goldman Sachs banker succeeded. He got the ratings agencies to call it equity, to classify it as equity. I didn't know. When that happened, I remember looking and said, why would they do something like this? So I actually called one of the people who's on the committee at the ratings agencies that decided to classify it as equity. And I asked them, why do you do this? And they gave me two reasons. One incredibly stupid and one mildly stupid. You want to hear the incredibly stupid reason first? They said it was called preferred stock. Really? That's your reason for calling something, for classifying? Hey, let's go on a renaming convention on the balance sheet. Let's call everything stock. No, those bank loans, no, they're not bank loans, they're bank preferred stock. That's an incredibly stupid reason. So that's an incredibly stupid reason, in case you're wondering. Here was the other reason he gave, and this was only mildly stupid, and it has a ring of truth to it. He said trust preferred stock does not come with a maturity. In other words, there's no date of maturity. There's no way. And he said usually debt comes with a maturity date. Equity is a perpetual security. Therefore, it should be called equity. It doesn't have a finite maturity. There's a ring of truth there, but here's why it doesn't hold up. You know, in 1999, two companies issued 100-year corporate bonds. 100-year corporate bonds. Usually corporate bonds are 10 years, a few are 30 years, but these bonds are 100-year corporate bonds. You know the two companies were? One was Boeing and the other was Disney. Now, what did this guy say? If a bond has no maturity, it's really equity, right? That's basically what the ratings agency is saying. Once you've gone to a 100-year bond, why stop at 100 years? Why not make it 10,000 years, 100,000 years? Why not make it a perpetual bond? In fact, the British and the Canadian government used to have bonds called console bonds. Console bonds don't have a finite maturity date. They last forever. And if you're going to treat something as equity because it doesn't have a maturity, my advice to companies, just issue console bonds to be treated as equity. You can keep issuing debt from now till the cows come home, but your rating will say AAA. Trust preferred was among the most widely popular new securities created in the 1990s. If you worked at an investment bank in the 1990s, there had been incredible pressure on you to sell trust preferred to pretty much every corporate that walked in through those doors because you had earned huge commissions relative to straight debt. The incentive was, look, you can issue debt and get your rating to go up at the same time. This is like having your cake and eating it too. You get to issue debt and you get a better rating. So my question for you is, let's assume that you are the banker caught in the middle. You've been asked to sell trust preferred, but you have a little bit of a conscience left. You want to make sure that you're not selling trust preferred to companies in a way that it's going to ruin them. So I have a question about what types of companies you think would be good candidates for trust preferred stock. Remember, trust preferred, you're committing to make fixed dividend payments. Those dividend payments are tax deductible, and if you fail to pay them, you get into trouble. You're trying to get companies to issue the security. I'm going to give you two groups of companies, and Shreya, I'd like you to tell me which of these two groups is a better candidate for issuing trust preferred, where there'll be less damage to the company. The first company is under-levered. It has too little debt, but it has a rating constraint. That's why it's not borrowing money. It says, look, we don't want to be below a single A, so they've held back on borrowing money. The second company is already over-levered. They're already in trouble, but they might be able to get away with issuing trust preferred because they're getting under the radar. The ratings agency doesn't notice they're issuing debt. So which of these two companies is a safer candidate for issuing trust preferred?
The first.
And the reason is they're under-levered, they have the capacity to borrow money. Now they can issue the trust preferred. And because they have the cash flows to service the dividend, they can pay the dividend, and their rating is not affected because the ratings agency is being fooled. See the problem with the second company issuing trust preferred? You might fool the ratings agency and your rating will not be affected. But guess what? You were already over levered. You were having trouble making your interest payments. I've added a cash flow on top of that. You remember the old question of a tree falls in a forest and nobody hears it fall. Did it really fall? It's kind of one of those stupid questions that people ask. You could ask the same question about a company that's borrowed too much money. If you borrow too much money and nobody knows you borrowed too much money, have you borrowed too much money? The answer is yes. You know why? Because somebody lent you the money. They're going to show up for the interest payments. And guess what? You could go bankrupt with a BBB rating or a single A rating, but you're still going to go bankrupt. Too many times I see both banks and companies think of this as a game, where they think that the end game is to fool the ratings agency. And for decades, investment banks have played this game of trying to create securities that look like equity, but are really debt. Trust preferred worked for about 5 years. Worked in the sense companies issued trust preferred, the rating stayed high, the ratings agencies were fooled. Until you know what happened? A company that issued a lot of trust preferred actually defaulted. And the ratings agencies said, oh my God, what did we miss? And it was right there in front of them. So by the late 90s, ratings agencies were already starting to treat trust preferred the way it should have been treated, which is mostly debt. You know what banks did? They created a new security with 3 degrees of separation, because with each of these securities, what are you doing? You're trying to create a separation between the borrowing company and its own debt. 3 degrees of separation, then 4 degrees of separation. You know what you finally end up with? You end up with an Enron. I know there are lots of stories about Enron. You can watch movies about Enron, but I am convinced that if it was 1999 and I'd walked into the Enron, Jeffrey Skilling's office at Enron, and asked him a very simple question: how much money do you owe as a company? He wouldn't have known the answer to the question. That's kind of a scary place to be, right? You're a company, you don't even know how much you owe. You know why? Because they'd created such degrees of separation between themselves, they had special purpose entities that borrowed for them, that they'd hidden away from the company, that they didn't know how much they borrowed. Can you imagine doing your optimal debt ratio calculation without knowing what your actual debt ratio was? If I asked you, are you under levered or over levered? Your answer is, I have no idea. This is not a game. The objective is not to fool the ratings agencies, it's to make sure you're not borrowing so much money that you're putting your survival at risk. So let's see where we are. You designed the perfect debt. You made sure it passes the tax scrutiny that it needs to be treated as debt. You try as best as you can to finesse your security, to make these different interest groups reasonably happy. And then you get ready to issue your bonds and you realize that nobody will buy your bonds. Why? Either because you've never issued bonds before as a company, you have no history in the bond market, or because you've issued bonds in the past and you have a bad history with bond markets. If you're a technology company that's never borrowed money, the first time you borrow money, people might hold back saying, hey, can I buy those bonds? Will they actually pay me back? I'm not talking about the Apples and the Facebooks, but you're a small tech company. That's an example of the first. You've never borrowed money, you have no history. People are holding back saying, can I trust this company? For example of the second, remember the story that we said of, and this was right at the start of the class, of RJR Nabisco in 1988, doing a leverage buyout and becoming a private company. 4 years later, RJR Nabisco went back to being a public company and decided to issue bonds. And nobody would buy Nabisco bonds. And do you blame them? Because remember what happened the last time you bought Nabisco bonds in 85 or 86 or 88 when you did the LBO, the bond price dropped 21% and Nabisco stockholders laughed all the way to the bank. These same guys are trying to issue debt again. Definitely not buying those bonds. You think, what do I do then? You got to sugarcoat the bonds to provide bondholders some protection. You got to give bondholders protection against your own actions. So I'll give you an example of a couple of the protections that came about after the Nabisco fiasco. If you remember, what caused Nabisco bondholders to lose value is they bought these AA rated bonds that became BB rated after the LBO. And you were stuck with the old coupon rate. So one of the things that Merrill Lynch invented were rating sensitive bonds, which is your coupon rate would adjust to whatever your new rating was. Do you see how this would have helped you with the Nabisco bonds? Your coupon rate was 6% with the AA rating. You go to a BB rating, the coupon rate gets reset to 12%. Bonds were more likely to be convertible bonds after 1988 than before 1988. You're saying, how does it help me? Remember, who's ripping you off? It's the equity investors, right? So you know what you do? You say, you rip me off too much, I'm going to become one of you. Then who are you going to rip off? You're essentially adding features to the bond to make bondholders feel more comfortable about holding your bonds. You're not doing it out of the goodness of your hearts, but if you don't do this, they assume the worst about you. They charge you a really high interest rate. You've designed the perfect debt. You've got the tax okay. You've kept these different interest groups, ratings agencies, equity research analysts, regulators reasonably happy. You've sugar-coated the bond enough to issue it. There's one final thing that you probably need to watch out for. You want to make sure you don't lock in market mistakes that work against you. Let me explain. Let's assume you're a company with a BBB rating, but you believe you should have a AA rating. Based on your financials, based on your health, you believe the ratings agencies have screwed up and given you too low a rating. Let's say the right kind of debt for you is long-term fixed rate bonds. So in a normal world, you'd issue 10-year fixed rate bonds. You know why you might not want to do that right now? If you go out and issue those bonds today, guess what investors are pricing you as? A BBB rated company. They're going to charge a higher interest rate and you will be issuing the bonds at a lower price than you should be. That's a market mistake. If you go out and issue debt now, you're locking in that mistake. So you're saying, what do I do then? Well, you might decide to take short-term debt and try to convince the ratings agency that they've screwed up. It might not work, but you can see that this is a scenario where you're trying to avoid a market mistake that works against you. But what if you have a market mistake that works in your favor? You know what I mean by that? Let's suppose you should really be a BBB rated company and the ratings agencies have screwed up and given you a AA rating. William, if you're really a BBB rated company and ratings agencies have screwed up and given you a AA rating, what are you going to be tempted to do?
Issue more corporate bonds. Issue more
as much debt as you can, even if you don't need the money. You can see why, right? Because you say, look, they screwed up. I'm going to go out and issue these bonds at this really low rate, lock in the rate for the next 30 years. It's one of the great quandaries in corporate finance is when the market is screwing up on your securities, do you try to take advantage of the market, right? In this case with rate, can you imagine how much this becomes an issue with your stock? Let's say Zoom believes, let's say the Zoom CFO believes in his heart, he will never say this out loud, that they're massively overvalued, that they're trading at double the price they should be. You see what you're going to be tempted to do as Zoom then? Go out and issue as many shares as you can and collect the proceeds. You're not creating value for the company, you're transferring wealth, right? You see from whom to whom? From those new shareholders who are paying this amazingly high price to the existing shareholders. So again, the GameStop, I mean, I don't know what was behind the GameStop CEO resigning. I'm sure there's incredible pressure at GameStop to go out and issue as many shares as you can now. But the problem is you're playing a very dangerous game. You know why? Because if you're right, the price is going to come back down. And a year from now and 2 years from now, when you're in front of your shareholders at the shareholders meeting, guess who's at the meeting? All those people who bought the shares at $300 per share, and now you're trying to convince them that at $30 per share, it wasn't your fault. Good luck with that. But when you see markets make mistakes on either your debt or your equity, you're going to be tempted to take advantage of it. And my advice is if you really need the capital to take projects, of course you should raise money. It's not your fault that the market is screwing up. But if you go out and raise way more money than that, then what are you going to do with that money? You're going to be tempted to do stupid things. This is what the telecom companies in the late 90s, they went out and issued bonds like they were going out of style and then wasted the money because they had nothing to really put the money in. So if you were to summarize these steps, and this page looks intimidating, but I've just summarized the previous 5 pages into one page. Here's the sequence. I am your client and you're my advisor. You can be my banker, my consultant. I come to you and say, what's the right kind of debt for my company? The first thing you need to do is listen. You know why? Because you need to talk to me about what's a typical project look like for you? Is it long-term or short-term? What kind of pricing power do you have? Because that's your first step, is designing the perfect bond. The second stop is you got to make sure that that is okay in terms of providing the tax benefits you hope to get. Third stop, keep these different interest groups happy: equity research analysts, ratings agencies, regulators. Sugarcoat the bond and then check one final step to make sure you're not locking in market mistakes. There is a market for good advice on debt. Unfortunately, a lot of advice on debt is cookbook advice. You know what I mean by cookbook advice? You ask an investment banker, what's the right kind of debt for me? You know what you're going to end up getting? Whatever you used on the last company or she used on the last company, because it worked at that company, which is like going to a doctor and the doctor tells you you have cancer and you say, you haven't even looked at my charts. Well, the last patient who came in had cancer, so I'm going to tell you you have cancer. It's a terrible way to mete out medical advice. But that's the kind of investment advice you often get with debt. Is there's almost no thought about what's right for the client and what the right kind of debt for the company is. Any questions on debt design? Because we're now going to go through some practical ways in putting this into play when you look at real companies. I'm going to describe 3 different ways in which you can design the perfect debt for your company. And I think the first way, which is the most intuitive, is really the one that I would focus on the most for your company. So for intuitive approach, you start by looking at what kind of projects do you have? Are they long-term or short-term? So basically you ask questions of the company and you try to design debt based on answers to those questions. So I'm going to start with that. The second way of deciding the right kind of debt for you is project specific. You have a really big project. I'm going to give you tools which you can use to assess what's the right kind of debt for this specific project. A new theme park for Disney. You say, what's the right kind of debt? It's a relatively simple process built around the cash flows we use to decide whether the project was a good project or not. And the third approach is driven by data. And here's what I do. I look at your history as a company. And if you've been around like Disney has for 100 years, I look to see when you do well and when you do badly. Do you do well when interest rates are high, when interest rates are low, when inflation is low or inflation is high? And based on your history, I devise debt that meets your specific movement with markets. It's like it's very similar to what we did when we looked at betas. We looked at the past history to get a sense of, is my company risky or not? So let's start with the intuitive approach. And let me use Disney to illustrate this approach. What's the right kind of debt for Disney? That's kind of a silly question because Disney is a company in multiple businesses. So here's what I'm going to do. I'm going to take each business and I'm going to try to devise the perfect debt for that business. The first business that Disney is in is the movie business. What does a typical project look like in the movie business? Usually short term, 2 to 3 years. You don't take 20 years to make a project. For Disney, at least in 2013, most of the movies were made domestically. So the cash flows tended to be in dollars. That's shifting though. As you look at action movies, you get a lot more foreign revenues. And the thing about the movie business that makes it different from most of the businesses is it's a very skewed business. You have a few really big hits and lots of losers. Now, and you can see this, right? And you sometimes go on Netflix and check past movies. You look at that movie, I've never heard of that movie. And these are movies with big names in them. because most movies come and go and we don't even notice that they're there. You're saying, okay, so how does this help me? So let's say we can design the perfect debt for a movie company. So maybe this wouldn't be right for Disney, but if you were asked to do this for Lionsgate, which produces one movie every year or two, and if it's a hit, it makes a lot of money. If it's not a hit, it loses a lot of money. Let's think about how we design the debt. First, we make it short-term debt, right? Because movies don't take 20 years to make. Second, we tie it to the currency in which we get the cash flows on that movie. So that movie is primarily for domestic markets. It should probably be in dollars, but if it's an action movie that gets half its revenues in Asia, maybe I'll devise it differently. So the currency will depend on the type of movie. And here comes the fun part. Can I make a bond for this business reflect the underlying, the fact that a few movies are huge successes and a lot of movies lose money? Well, what if I could tie the coupon on this bond to how well the movie does? In terms of gate receipts, right? If your gate receipts are $1 trillion, then I'll pay a 10% coupon rate, but if your gate receipts are only 50 million, the coupon rate drops to 2%. Again, you're saying who'd buy that bond? Trust me, there will be people out there who think they know the movie business better than you do. They'll make bets on your bond. You say, this is completely implausible. Nobody would buy a bond like that. You'd be surprised at what people buy. You heard of Bowie bonds? Remember David Bowie? The guy with the spiky hair, I mean, I think he died a few years ago. Did he die? I don't want to kill people off before it's that time. I think he's dead. In the early 90s, David Bowie had a fight with his record company. And he bought back the rights to all of his music, which left him with a cash flow problem. Rock star cash flow problem don't go together because how do you maintain the 6 houses and the 12 rolls and all the rest of the stuff? So here's what he did. He went to an investment banker in New York who bundled all of his music rights and issued bonds against that music. You think, so what's the big deal? He tied the coupon rate on the bond to how many records Bowie records David Bowie was able to sell. Remember, these were the days before iTunes. Today, you tie it to how many times do people download your song of iTunes. They're called Bowie bonds. So Bowie's had 5 platinum records, a coupon rate would be 15%. But if tomorrow we all woke up and said, David Bowie, terrible singer, I'm not listening to his music ever again, the coupon rate actually dropped to 0%. That's a Bowie bond. If David Bowie can issue Bowie bonds, why can't Disney issue movie bonds? In fact, Disney did have a Little Mermaid bond. People bought it, but it never got traded. They bought it and they actually demanded the certificate. They hung it up on in their houses. It became part of, a collectible market. So the movie business, short term for Disney, mostly in dollars. And if you can, tie it to the success. But if you have an Avengers movie, it's going to be a surefire hit. There, you're not going to do this, right? So you're going to do this only if you're uncertain about whether your movie is going to be a hit or not. Take the broadcasting business. Again, typically short-term projects, right? But to the extent that a TV show catches on, you get multiple seasons. So The Mandalorian is not going to be a one-season hit. It's going to be every season for as long as Disney Plus is around. So it may be short-term to medium-term. Again, it depends on where you get the hit. For Disney streaming right now, I think 70% of their streamers are US-based, but as it gets more global, maybe a mix of currencies. But in the old broadcasting shows, it used to be driven by advertising revenues. We'll talk about how to be different in the streaming business. The old broadcasting shows were driven by ratings, not bond ratings, but by Nielsen ratings. So if you were designing a perfect bond for a pure TV show company, you'd probably make it short to medium term. The currency would depend on where the show was watched. And if you could, you try to tie the coupon rate to the ratings on the show, right? If it's a highly rated show, you're going to be willing to pay a higher coupon rate. Now, I hope you're getting a flavor of what you're doing. You're basically trying to design bonds where you're willing to pay more when you do well, but you also get to pay less when you do badly. It gives you that flexibility. If you look at the theme park business, this is by far Disney's longest term business. I would expect it to be the part of Disney that issues really long-term debt. Remember those 100-year bonds that Disney issued? This would be the business where it makes the most sense. So you're going to open a Rio Disney, it's a go for 100-year bonds. The currency on the debt should reflect where you get the tourists at that particular theme park. So if you're building Rio Disney and you think it's going to be primarily Latin American, then you're going to demand that your debt reflect that mix. If you're looking at funding US theme parks, mostly in dollars. And at least in the case of theme parks, it's going to be driven, for Disney, it's going to be driven by how well the movie and the broadcasting business are doing. There's a feedback loop. So again, if you're designing the perfect debt for just the theme park business, it's going to look very different from the debt for the broadcasting and the movie business. Consumer products, Disney has increasingly shifted to licensing its consumer products. It doesn't make and sell them. Because licensing revenues are pretty stable and predictable, this would be the kind of debt. We have medium-term debt, and your coupon is tied to the predictability of your revenues, most likely fixed rate debt. And finally, if you look at what they call their gaming business, the projects were mostly short-term because every game lasts only 6 or 8 years. So this would be the debt if you had short-term debt, maybe even convertible debt, because to the extent that you can tie to the success of the business. I'll leave you with the question of if I were creating a streaming business like Disney was streaming, and I wanted to borrow money just to fund the streaming business, what kind of debt should I have? And it's an interesting exercise in understanding what does a product look like in the streaming business? How do you keep a streaming business going? Because that's going to determine what kind of debt you take on. So think about your company, right? So Dan is Lockheed Martin. Lockheed Martin, what would do? So if you are doing it off the spur of the moment, you think about what's the right kind of debt for Lockheed Martin? Typical project, long-term or short-term?
Long-term.
Very long-term. And they get most of their revenue still from the Defense Department. I would assume that those are fixed payments. So I would say it's probably fixed rate debt, because it's cost plus you're passing it through. Yeah. It'd be nice if I could tie the coupon rate to how much the defense budget goes up that year. I'm not sure whether this is feasible, but if I could do it in a way in which I tie it to whether the defense budget is up 10% or down 5%, it'll give me some protection.
I have a question about the Rio Disney. So if you issue the 100-year bonds and then you decide the project 3 years in isn't worth it or it's not going as planned, do you make the bonds puttable, or what do you add a covenant?
Well, if you worry about Disney's never closed a theme park that they've opened. I mean, it's in a sense almost, it becomes a sunk cost, right? It becomes very difficult. It goes back to the California Adventure example. But if you feel that you might suspend a project, it'd be nice to have an escape hatch, which you'd make the bonds puttable so that when you shut the project down, you could put the bonds back. And if you could tie it to the liquidation value of your project, even better. The more flexibility you build into your debt, the better off you are because it gives you options you otherwise would not have. Any other questions? So now let's look at the second way you can get debt design going. Let's suppose you have a really big project. And you're saying, what's the right kind of debt for this project? Project financing is an entire business to itself because you're funding big infrastructure projects, toll roads, dams, power plants. You're saying, what's the right kind of debt? It's actually relatively simple if you remember what we did in capital budgeting. Remember that Rio theme park we looked at where we projected the cash flows on the theme park? So this was from originally when we did capital budgeting. There are our cash flows. There's my terminal value at the end of year 10, and we did a present value. So net present value of the theme park was 3.3 billion. You say, but that was investment analysis. Now let's assume you have these cash flows in there. Hey, given those cash flows, can you tell me what kind of debt is right for this theme park? Let's start by answering the question. I mean, this is clearly a long-term investment. How long-term should my debt be? And let's say I want a precise answer. Foundations, I'm sure you did the duration of a bond. Do you remember how you compute the duration of a bond? Basically, a duration of a bond, if you think about it intuitively, is like a weighted average of when your cash flows in the bond come through. So if you have a long-term bond with a very low coupon rate, the duration of that bond is much longer than a shorter term bond with higher coupons, where you get the cash flow up front. In fact, there's a measure of duration called Macaulay duration. It's a very simplistic measure of duration. Here's what you do. See these present values that you get from just discounting the cash flows? You take the present value you get in each year and you multiply it by whichever year you get the cash flow. So in year one, for instance, minus $1 billion discounted back 1 year is minus 922. I multiply minus 922 by 1 year. I take the minus 730 multiplied by 2. So each year's present value I multiply by which year I get that cash flow. And then I add up those numbers. What I get as my sum is about 62,355. You're saying, what do I do with that? If you divide the 62,355 by the 3,296, you get 18.91 as your answer. You're saying, what does that mean? That is the duration of the cash flows on this project. Why is it so long? Because I have big negative cash flows up front and my big positive cash flows way at the end. If I wanted to be a purist, the debt I need to issue would roughly have to have a duration of about 19 years. Not a maturity, but a duration. You know, 30-year bond has roughly a duration of about 18 to 19 years. If I believe my cash flows on this project, I'd be issuing 30-year debt. Now, which currency is going to be an issue of where do I think the tourist to a Rio Disney theme park is going to be? And given that it's in Rio, my guess is a mix of Latin American currencies would be my best choice. And here I might run into a market problem. If I try to issue 30-year Brazilian real bonds, it's very likely that I might not find any investors for that bond. Why? Because investors in Brazil in local currencies don't like to buy long-term bonds. They just don't trust the currency. So you know what I might have to do? I might have to issue 30-year US dollar bonds, which is a mismatch, but then use derivatives markets to kind of correct that mismatch. There are futures and forwards where I can convert dollars. So if you cannot issue the bonds in your perfect currency, you can always issue it in a different currency and use futures and options on currencies to kind of fix the mismatch. But if you gave me an individual project, I can actually design the perfect debt for that project based on the same cash flows I used to make a judgment on whether that project was a good project or a bad project. So you can do the intuitive analysis. We have a big project. You can do the project cash flows, which brings me to the third approach. Question, Brian?
Yeah, if your park's in Rio, wouldn't you expect tourists to pay in reals no matter what?
They would, but remember that what drives your revenues is where you, so let's say Argentina goes to hell in a handbasket and 30% of your tourists come from Argentina. Your cash flows, even though everybody is paying in reals, fewer people are paying at the gate. Ultimately, what you're looking at is how much do I get as collected cash flows? So the underlying risk is I am dependent on Argentina doing well and Uruguay doing well and Chile doing well, and they're all doing badly. Guess what? My cash flows are going to drop to reflect that. So even though everybody in Orlando pays in US dollars, the reality is 50% of the tourists in Orlando come from Europe and Latin America. 30% of the tourists in Disneyland come from Asia. Whether I like it or not, those risks are underlying my cash flows. And that's why I might still use a mix of currencies depending on where the tourists come from rather than what currency they pay. Which brings me to the third and final way of designing the perfect debt for my company. And this will work only if your company's been around a long time. So don't try this on a Spotify. Don't have enough history. Don't try it on Pinterest. It doesn't have enough history. But you can definitely try it on a Lockheed Martin or a Disney or a company that's been around a long time. And here's what I'm going to do. I'm going to look at your company's operating cash flows. Now, operating income, or, so you can use free cash flow, EBITDA, EBIT, look at its history. And look at what the years in which it goes up and the years in which it goes down. And I'm also going to look at your market value as a company, which includes both debt and equity and enterprise value on a year-by-year basis. So let's have 50 years of history on your company, or 40 years, I can collect the data. So in the case of Disney, I collected the data for about 30 years, from 1985 through 2013. I collected the operating income every year as my proxy for my income go up and down. And I also collected the enterprise value each year. So that's a debt plus equity minus cash every year going back 30 years. I computed the percentage change in operating income and the percentage change in value every year. So there have been good years and there have been bad years, stating the obvious. So if you took a look at a year like 2009, the operating income was down 23%, the enterprise value was down 18%. I have a history of Disney's good and bad years. You know what I'm going to try to do? I'm going to try to see if I can explain what types of scenarios Disney does well in and when Disney does badly by looking at macroeconomic factors. And I'm going to focus in on 4 macroeconomic factors. And with each one, I'm going to talk about why I think it matters in terms of design of debt. First, I'm going to look at what T-bond rates do, what interest rates do. I want to see how sensitive Disney is as a company to changes in interest rates. Does it do well when interest rates go down? Does it do well when interest rates go up? Second, I'm going to look at percentage change in GDP every year. What does that tell me? It tells me whether Disney is a cyclical company, a company that's affected by how the economy is doing. Third, I'm going to look at inflation changes every year to see if Disney is a company where inflation goes up. Is it helped? Is it hurt? Or is it unaffected? And finally, I'm going to look at the US dollar. When the US dollar strengthens, is that good for Disney as a company or bad? It's completely backward looking. But you see what I'm trying to do, right? I'm trying to gauge from the data what makes Disney do well and what makes Disney do badly. So the first of these analyses I'm going to run is against changes in interest rates. This is something that right now is probably a very critical factor because everybody's concerned about where T-bond rates are going to go. And if you have a company, you're saying, will my company be helped or hurt if T-bond rates go up? And I'm going to look at history to make that judgment. And I'm going to argue that when I look at how my company moves with changes in interest rates, I'm actually getting a sense of whether my debt should be long-term and how long-term my debt should be. You say, why would that matter? You're going to see in a minute when I show you what Disney's done as interest rates change. So here's the first thing I did. I took the change in enterprise value every year, so there's 40 years of history, and ran a regression against the change in interest rates. So I took the change in interest rates every year, change in Disney firm value. Not an exciting regression. The T statistic is not significant, but let's say what the sign tells you. If you believe this regression, it looks like when interest rates go up, Disney's enterprise value drops. For every 1% increase in interest rates, Disney's enterprise value drops by 2.4%. The reason I'm not going to get too excited with that T statistic, this might be complete noise. But to the extent that the regression is sending me a message, is higher interest rates affect Disney's value, they knock down the value by about 2.4%, but not enough to be statistically significant. I also tried, and I'm going to argue that that coefficient of 2.4, if you believe it, is actually a measure of the duration of Disney's assets. Now, to see the connection, I'm going to take you back to foundations and revisit the definition of bond duration. You know, the definition of bond duration is it's a percentage change in your bond price for a unit change in interest rates. That's what a bond duration measures. How much does the bond price change for a 1% change in interest rate? So when you tell me the duration is 7.5, you can think of it as 7.5 years as duration, but you can also think of it in the following way. A 1% increase in interest rates reduces my bond price by 7.5%. So keep that in mind. The duration of a bond is the percentage change in the bond price for a 1% increase in interest rates. Think of what the regression gave you. The regression gave you the same answer, right? For Disney, when I ran a regression of percentage changes in the firm value against percentage changes in interest rates, I was answering the same question. For a 1% increase in interest rates, how much does Disney's value change? The reason I can't do a traditional bond duration for a company is unlike a bond where I have the future coupon payments and the face value, for a company, I don't have future cash flows. That's why I'm looking backwards. But if that regression is dependable, the coefficient you get on the regression, of minus 2.4 that you saw, is a measure of the duration of your company's assets. So if I believe this regression, Disney's assets have a duration of only 2 to 3 years. But I have qualms because the T statistic is too low. I also did a regression of changes in operating income against changes in interest rates. And here I got a stronger output. Not hugely strong, the T statistic is still 1.4, but a 1% increase in interest rates reduces Disney's operating income by about 7.94% or 7.93%. So here's where we are. A 1% increase in interest rates reduces operating income by 7.93% at Disney. It reduces firm value by 2.4% or 2.3%. But that 2.3% can also be viewed as a duration for Disney's assets and can be used to decide, how long-term should my debt be. That was my first stop, looking at how Disney's firm value and income did as interest rates changed. Any questions on that regression and why it might give you useful results on your company by looking at the past?
Do we run a regression on every macroeconomic factors or just focus
Only the ones that you think will matter. So if you're doing MTN, for instance, you might say, look, I'm a telecom company. What are the macro variables that will drive my firm value? The classic ones are interest rates, inflation, GDP. I mean, those will always show up because you always care about, hey, how does MTN do when you have a recession? Does the income fall off? It might be that they're unaffected by recessions because, telecom service is something you pay for in good times and bad times. But you're looking at the historical data to get a sense of, at least on those three variables, on what drives it. And you might add others. If you're looking at an oil company, what's a logical variable to throw in?
oil price?
Oil price, right? If you're looking at airline, I'd throw in oil prices too. You know why? Because that oil price becomes an input into my airline. So if I'm an airline, I'm out to devise a bond that protects me if oil prices go up. So I will throw in whatever matters for that particular company. If I'm looking at, McDonnell Douglas, or I'm looking at any other defense company, I might throw in the changes in the defense budget year to year to see how it affects my operating income and value. So there's nothing that stops you from bringing in something that worries you in your company and say, is it true? How is my company affected by changes in the variable? Shenhua?
Can we do this on a very relatively young firm? Because I think there will be a lot of noises in the
Absolutely. That's why I said if you have Spotify, I wouldn't even try this. In fact, I'm going to tell you not to even try this on your company, because even with 30 years of data, look how weak my results are for Disney. When you look at the T statistic, right? Even if you go back and look at the T statistic, 1.4. Statistics class that will never pass muster. And the T statistic on the other regression is even worse. It's 0.39. And that's with 30 years of data. Imagine having 4 years of data. So I'll give you the spreadsheet that will allow you to do it. You can try it if you want for your company. Maybe it'll work. But for most of your companies, the noise is going to drown you out. But I'm going to give you a way in which you can get around the noise. And it's actually going to draw on what we did when we did betas. When we did betas and they were noisy, and we said, don't trust the regression beta. What was our solution to that? Dwanish, do you remember? What do we use instead of a regression beta?
A bottom-up beta.
A bottom-up beta. What if I could do this for every entertainment company, every defense company, every steel company, and give you the average coefficients across 50 companies? Maybe that would be more meaningful. But with individual companies, the noise is going to start to drown out whatever results you get, because you just don't have a strong enough relationship and enough historical data to eke it out. So now let's look at how Disney is done as a function of the economy. So I'm going to use changes in real GDP over time. I've sent you this link before, but if you've never used it, check it out. It's a Federal Reserve site called FRED. It's I think St. Louis Federal Reserve that maintains it. It's the most amazing macroeconomic database in the world by far. Now, you want to look at real GDP changes going back to the 1920s, you can go there. Interest rate changes going back to the 1920s, you can go there. You can look at bond spreads going back 100 years. And it's all free. It's set up incredibly well for download and playing. So if you get a chance, visit it, because that's where you get the real GDP changes. Matthew?
Yeah, just a question about the sensitivity to interest rates. Were those long-term interest rates, short-term interest rates,
There's
or
a T-bond rate.
parallel shifts?
There's a long-term rate. But you could actually add a short-term rate as well if you think your company is affected by the term structure, which is another thing that people often throw in as a macro variable. You can either throw the T-bill rate in separately or the difference between the T-bond and the T-bill rate as a variable and see if that explains. This is an exercise in just exploring the data. Say, let me see what variables best explain how my company does. And
So
there's
you could
nothing
have
that
done it
binds.
for, yeah, you could have done it for any interest rates and just
You could
see,
have done
you
for
know,
any
which is
interest
the
rate,
strongest
right?
predictor.
Absolutely. You can do it against default rates. Maybe that's the thing you're worried about. If you're a bank, you might say it's a spread that I worry about. Now, so you can throw any macro variable that you can find that you think will matter in your company, because you're then going to try to design debt that captures your exposure to that macroeconomic variable.
Thank you.
So let's move to the second variable, changes in real GDP. By looking at this regression, what am I trying to find out? I'm trying to find out whether my company is a cyclical company, how it's affected by the economy. Does it do well? How much is it affected when the economy goes into recession? Why is this going to matter? First, it might affect how much I borrow. If I'm a very cyclical company, I'm going to be much more cautious about borrowing than if I'm a non-cyclical company. Why? Because if I enter into a severe recession, I'm going to be in trouble. If I'm less cyclical, then maybe I can afford to borrow more money. So with Disney, here's what I got when I looked at operating income and firm and enterprise value. So again, I'm using both measures of Disney's performance. When you look at enterprise value versus real GDP growth, every 1% increase in real GDP growth increases my firm value by about 6.7%. What does that mean? Well, it looks like Disney overall is a cyclical company. When the economy does well, they do much better. The T statistic is now significant. Unlike those interest rate regressions, here there's actual significance. When I look at operating income, I get the same kind of phenomena. 1% increase in real GDP growth increases my operating income by 6.6%. Yeah, but wonder, why am I tracking both? Operating income looks at the immediate impact of the macro variable. What happens to earnings this year? Enterprise value looks at the overall impact in the long term in my company. So they're giving you different messages or different pieces of information about the same company. So at the end of this regression, what's the bottom line? I think Disney is a cyclical company, which is something they need to factor in when they think about how much to borrow. So we've looked at interest rate changes, we looked at real GDP. Let's see how Disney is affected by how the US dollar does. Again, let's start with intuition. When the dollar gets stronger, some of Disney's businesses are hurt. Like the theme park business in the US is hurt because when the dollar gets stronger, it makes the ticket price more expensive to people who are not from the US. A Latin American traveler to the Orlando theme park is going to pay more when the dollar strengthens. But there are other businesses where Disney might benefit from a stronger dollar. Their revenues in China, transported back to the US, might be affected by a strong, but if their costs are in China, it might benefit them. So let's see how Disney is affected by currency changes, because that's going to determine what kind of currency they should use in their debt. So here's what I did. I took the change. This is actually a great database maintained again by Fred, where because normally when you think about did the dollar get stronger or weaker, you have dozens of currencies, dollar against the euro, dollar against the pound, dollar against the yen. They create a weighted dollar index, Fred does, where they take the dollar against different currencies and weight it by how much trade the US does with each country. So obviously the euro, the euro and the yen and the renminbi are weighted more than maybe a smaller currency. So if you look at what happens to Disney when the dollar strengthens, a 1% increase in the dollar reduces firm value by about 0.57%. So a stronger dollar does hurt Disney's value, but the T statistic is not significant. When you look at operating income, a stronger dollar does reduce operating income, and there the results are most statistically significant. A 1% increase in the dollar reduces operating income by 1.68%. So I'm collecting information as I'm going along about what affects Disney. Which brings me to my final regression. where I take Disney's enterprise value and operating income and look at how it moves as inflation changes. You know why I care about this regression? One of the things I talked about was pricing power. A company with pricing power, I said, can go out and use floating rate debt. What does pricing power mean? When inflation is high, they can push up prices and pass it through. When inflation is low, they can push down prices and let it go through. So when I run a regression of firm value and operating income against inflation, I'm getting a measure of pricing power. Strong pricing power companies, you should see that inflation just passes through to their operating income and into firm value. So let's see if Disney has pricing power. Again, if you look at firm value, kind of neutral. Even though every 1% increase in inflation improves firm value by 3%, the T statistic is not significant. But look at operating income. Clearly, as inflation goes up, they're able to improve operating income accordingly. So again, I might be drawing too strong a conclusion, but based on this regression, it does look like Disney can pass through inflation to its customers. So I think I'm ready. If I trust these analyses, and you ask me to summarize what I've found with these regressions, here's what I would conclude. Disney's debt collectively has a duration of about 2.3 years. That came from the regression against interest rates. Disney is cyclical as a company. It does well when the economy does well, does badly when the economy does badly. Disney is hurt by a stronger dollar. And Disney's operating income does tend to move with inflation. They have pricing power. Now again, the caveat is every single one of these regressions has a huge amount of noise, big standard errors, many have very low T statistics. So here's a simple fix. Remember how we use bottom-up betas? Because by averaging across 50 betas, we got something more precise. I ran these regressions for every single entertainment company. It was a huge pain in the neck. It was the most work I ever did. I haven't done this in like 10 years. I haven't updated this table. I'm not sorry for not updating it because it was so much work. I said, I'm not doing this again. So I ran this regression for every company in the entertainment sector. And basically, I broke them down into broadcasting, theme parks. And here's what the coefficients look like on average across all companies within each grouping. You know what I can do? Rather than run the regression for Disney, I can go to this table. And if I look at the weighted average of what I get by looking at this table, it looks like the weighted average on interest rates is minus 4.34. You're saying, what does that mean? To the extent that I trust these bottom-up numbers, the duration for Disney's assets is roughly 4.3 years. They are a cyclical company. The coefficient is positive. The typical company in this business doesn't have pricing power. And the typical company in this business is hurt by a stronger dollar. Bottom-up estimates are an alternative to doing this on your company, and they give you more precise values. So let's summarize what we know about Disney now if you use the bottom-up numbers. Debt should be long-term with a duration of about 4.3 years. I would expect a significant portion of the debt to be floating rate debt. Why? Because the regression seemed to suggest that Disney has pricing power. And given how sensitive Disney is to a stronger dollar, I would expect a significant percentage of the debt to be foreign currency debt. In fact, it should be roughly 18% because I know given their revenues, they get 18% of revenues from foreign currencies. I'd expect to see at least about 18% of the debt be foreign currency debt. That's what I'd expect to see. So I went to Disney's balance sheet to see what their actual debt looked like. And here's what I found. Their actual debt had a duration of about 7.9 years, which will give you a duration of about 6. So the debt is slightly more long-term than I would like it to be, but not hugely so. If that number had been 15 or 20, I'd have come back and said, your debt looks like it's far too long-term. They'd only have about 5.5% of the debt as floating rate debt, which given their pricing power looks too low. And only about 5.7% of the debt was foreign currency debt, which given that 18% of the revenues come from foreign currencies, look too low. Based on my assessment of what Disney's debt should look like and what their actual debt is, my conclusion would be that they need a little more short-term debt, a little more floating rate debt, and a little more foreign currency debt. So if I ask for debt advice from Disney, I'd say, hey guys, you need debt needs to be a little more short-term, not not a big shift, but more foreign currency debt, more floating rate debt. And there are two ways Disney can fix this mismatch if they're willing to listen. The first is, if they're making any new debt issues, they can make them much more skewed towards floating rate foreign currency debt, right? Because that will fix the problem. Or they can do a swap. That's the other benefit you have in today's markets. You can swap it, you know how a swap works, right? So you take a long-term US dollar bond, you swap it into a shorter-term euro bond, maybe a floating rate bond of equivalent market value. So you gain nothing in terms of, or lose nothing, but effectively you've swapped out the debt you don't like. So you can either swap and adjust your existing debt or use new debt issues to kind of fix the problem. To me, this is one of those places, I think, where there's the most room for change in emerging market companies. And here's why. Until probably 15, 20, 25 years ago, if you're a Brazilian company, an Indian company, and you wanted to borrow money, guess what your only choice was? You went to the bank, and the bank loaned you money. And it always loaned you money as a 5-year fixed rate bond. Why? Because that's what banks do. You have a lot of emerging market companies, especially mid-cap and smaller cap emerging market companies, which have debt that doesn't meet their requirements. They should be using much more long-term debt or floating rate debt. Today, those companies have choices. The corporate bond market is now alive and available and accessible in emerging markets, not just in the US. And many of those companies are ripe for a debt an adjustment, because much of the debt they have on their books right now doesn't match up who they are as companies. Now, if you ask me to design debt for my other companies, I'm at least going to take a stab. Let's start with Bookscape. It's a privately owned bookstore in New York, right? You know the perfect debt for a retail company is? If you want debt that's tied to your business, that does well, and that you can walk away from if a business doesn't do well. A lease kind of fits the bill, right? Because it's matched up to the store. And if the store doesn't do well, you kind of walk away from that. There's a reason retail stores have historically used leases rather than buying and owning their own retail spaces. If you look at Vale, iron ore mining company, typical project is really long-term. And because it's a commodity company, almost everything gets done in US dollars. I would expect much of the debt to be long-term US dollar debt. And if I could add a clause, I would probably try to tie the coupon rate on the debt to how iron ore prices do. I'm not sure it'll fly, but I could try. But their debt is primarily. And in fact, they generate a large portion of their revenues in China, something to factor in when you want to design the debt. Their actual debt is primarily US dollar debt. It's pretty much long-term. So it kind of matches what I'd expect it to have. Tata Motors, if I were looking at designing debt for them, they don't have much pricing power, at least on their mass market business in India. So I'd probably want to stick with fixed rate debt, long-term debt, probably rupee debt for their Indian operations, and much more of a mix of foreign currency debt for their Jaguar Land Rover operations, which are a global business. And finally, Baidu is a technology company. All of its value lies in the future. Most of its value lies in the future. It's perhaps one of the few companies where I would push for a convertible debt, because they can't afford to make big interest payments now, but they could in the future. And given that their revenues are all in China, I'd expect the debt to be renminbi or yuan debt, because it's local currency debt. And this was the company where I got the biggest mismatch. Because Baidu had almost all of its debt outside China in a foreign currency. Now, I don't know whether they're using derivatives to kind of hedge the problem, but if they're not, they've got mismatched debt. And the problem with mismatched debt is it's not going to put you under, you're not going to default, but it's increasing default risk for no reason at all. You're exposing yourself to default risk you didn't have to, and it's so fixable. So let's review debt design. So when you look at your company, start with the basics. What does a typical project look like? Is it long-term or short-term? What currency is the debt in? Is it, does my company have pricing power? That is the biggest chunk of debt design, is making sure you're designing debt that is right for your company. And then if you want to bring in the quantitative factors, you have the numbers on a typical project, or you want to do this by looking at history, go ahead. As I said, do it with there's a grain of salt in that analysis, because even with a lot of historical data, it's very difficult to get statistical significance. There's a lot of noise in the relationship between firm value and interest rates, firm value and inflation. But I would, try it out, because I think at the end of that part of the process, you should at least have a starting point for what is it, does my company have the right kind of debt? And so that's the last step, is after you've designed your perfect debt, ask yourself, does the actual debt look close to what I'd expect it to? And if it doesn't, then you can suggest changes, that my company should have a lot more long-term debt, a lot less long-term debt, different currency debt, floating rates to fixed rate, or vice versa. And if you want to be truly creative, see if you can design something in the debt that will give your company protection against the things they most fear. Yeah. Any final questions on debt before we move on? So this is the last of the pages for your third quiz. So we're done with the third quiz stuff. So whatever we don't do on dividends on Monday will not be on the third quiz. The third quiz is entirely on debt. Dan.
So I have two questions. The first one would be, what if you expect wild fluctuations in the currency where you're doing maybe a third of your business? Would you just keep it? Would you not want to do that?
That's even more critical than you match up your debt to your assets, right? Wild fluctuations means it can go up or down. So if you match your debt up to your cash flows, both will go up and down together. And that's what you want. If you mismatch and you have wild fluctuations, then you're going to get squeezed in the middle. So the more fluctuations there are in your currency, the more critical that you match your debt up appropriately.
Okay. And then my second question is that when you were doing back testing, you said like an additional 1% in the currency, I guess, purchasing power hurt their operating income by 1%. Isn't there an inflection point where if the currency drops too much, that's actually going to have a negative?
Are we talking about exchange rates, or are we talking about inflation rates? Because I talked about inflation. When you say purchasing power, that's an inflation issue.
Yeah.
You're talking about the changes in your currency's exchange rates, or are you talking about the inflation rate change?
I guess the inflation rate change.
The inflation rate change has nothing to do with the currency, right? Basically, it's to do with, can I pass through inflation into my earnings? So imagine you're a company with no pricing power, right? Inflation goes up, your costs go up. But if you have no pricing power, guess what? You're frozen in your prices, you're going to see your income get squeezed. Airlines are terribly exposed to inflation because they don't have pricing power. But if you're a business with pricing power, you can pass it through. So what will happen is your operating income will also go up, your prices will go up. So by looking at the history, I'm trying to get a sense of, does my company have pricing power? Because if I have pricing power, that coefficient of inflation should be a big positive number. If I don't have pricing power, it should be close to zero. And if I'm actually affected negatively by inflation, that coefficient can actually be negative.
Okay, thank you.
You're welcome. Morgan?
Can I ask you why more companies don't use revolving credit facilities? Are there key disadvantages or?
Revolving credit is by its very nature short term, right? You know, when revolving credit makes the most sense is for transient requirements, something that comes and goes, you're not sure whether it'll be there. So if you have something that's long term that you need, might as well lock in the debt, rather than keep using. So revolving credit is more useful for companies where you're uncertain about what your financing needs are going to be, where your working capital needs can ebb and flow. So companies, and those companies do have revolving credit. But at Boeing, for instance, what's the point of having revolving credit, right? Your projects are long term, the revolving credit doesn't help that much. It's nice to have a credit line as a lifeline if you get into trouble. But it depends on the company and whether your future needs are more predictable or not. So, but the bottom line is if you can't design the perfect debt, you now have options. You can use derivatives, you can use options, you can use futures to try to hedge away the differential risk. But revolving credit is good for some firms, but for others, it's not doesn't help that much. Any other questions? Okay. So on Monday, when we come back, we will talk about dividends. And I'll send out the, the email I sent after class today. I'll send the links to the review session, the slides for the review session, past quiz 3s. But as I said, entirely focused on debt and debt design. Okay, so I will see you on Monday then. Take care.
Thank you.
You have a spreadsheet on how to create synthetics. Is that correct?
Synthetic
bond ratings. I think we went over it earlier. Do you have a video online on how to do that?
Yeah, it's called Rating.xls. So go to the, if you go to my spreadsheet section of my website, it should be there.
Okay, thank you.
It'll also convert your leases to debt as well if it hasn't been done already.